Assalamualikum OyaRahmatullahe OyaBarakatuhu. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial.
Now we want to quantify the relationship between risk and return. In other words, we want to measure how much additional return an investor should expect from taking a little extra risk. The classic theory that links risk and return for all assets is the capital asset pricing model. The basic theory that links risk and return for all assets. Now we will try to understand today's topic is capital asset pricing model, the basic theory which links between risk and return. Now risks, one is diversifiable risks, another is non-diversifiable risks. Diversifiable risks, the portion of an asset's risk that is attributable to from specific random causes can be eliminated through diversifications, also called unsystematic risks. So diversifiable risks, which risks can be diversified or which risks can be eliminated through proper diversifications, where if we making portfolio, then we can reduce the diversifiable risks, or you can call it the systematic risks. In the same way, non-diversifiable risks, the relevant portion of an asset's risks attributable to market factors that affect all firms cannot be eliminated through diversifications, is also called systematic risks. So non-diversifiable risks, which risks actually cannot be eliminated by the through proper diversifications, or if you make portfolio, then you cannot eliminate it. Non-diversifiable risks, you have to bear these risks, and this risk is called systematic risks. So here is the graph to understand the systematic risks and non-systematic risks, or diversifiable risks or non-diversifiable risks. It is clear. So we make portfolio to reduce our risks, or we make portfolio to diversify our risks. So if you see this diagram, then it will clear to us that the number of securities increases, diversifiable risks decreases. So in this graph, so in this y-axis, here is the portfolio risk, and x-axis is the number of securities. So if you increase the number of securities, then you can eliminate the diversifiable risks, or minimize diversifiable risks. So these are the total risks. You have to see the total risk, the combinations of diversifiable and non-diversifiable risks. So the risks which cannot be diversifiable, that is called the non-diversifiable risks, or systematic risks. So in this portion are the non-diversifiable risks, so it cannot be eliminated at all. So you have to bear if you make portfolio or not. So if you see, whenever number of asset 1 or securities 1, then they are create the total risks. Then if you increase your portfolio making 5 securities, then your risk is decreases in here, decreases in here. Whenever you increases your securities to 10, then your risk is decreases in here. So in this way, whenever you making 25 stocks, or securities portfolio, then your total risk is in here. In this portion there has the non-systematic risks, systematic risks or non-diversible risks, and the diversible risks can be eliminated near about to zero, not 0 but near about to 0, but it should not be eliminated at all. Diversifiable risks should not be eliminated at all, so it should not be 0. Here it is near about 0. If you making portfolio for the diversifiable risk, should be reduces but not eliminated at all. The model CAPM, CAPM, capital asset pricing model, in short it is called CAPM, links diversifiable risks to expected returns. We will discuss this model in 5 sections. First section deals with the beta coefficient, which is a measure of non-diversifiable risks. The second section presents an equation of the model itself. Third section graphically describe the relationship between risk and return. Fourth section discuss the effect of changes in inflationary expectations and risk aversion on the relationship between risk and return. And fifth section offer some comments on CAPM, CAPM. Now let us start from beta coefficient. The beta coefficient, it is symbolized beta, is a relative measure of non-diversifiable risks. It is an index of degree of movement of an asset's return in response to a change in the market return. So it is clear that a relative measure of non-diversifiable risks, an index of the degree of movement of an asset's return in response to a change in the market return. An asset's historical returns are used in finding the asset's beta coefficient. The market return is the return on the market portfolio of all traded securities. From the figure, we can understand the beta. So characteristics line is, this is the S line, which has a slope, that means beta is 1.3, slope of this line, and these are the characteristic line of R, which has a slope or beta is 0.80. So from this figure it is clear that asset S is more steeper than asset B or asset R. Asset S is more steeper and slope is 1.30. That means asset S is more responsible or by the change of market return. If the market return changes, then it more responses than asset R. That's why asset S has the more risks than asset R, because if market change 1%, then asset S is change 1.3% by the change of 1%. In the same way, if the market change 1%, our asset R change 0.8%. That's why asset A's is more responsive asset. That's why that is the more risky asset than R, asset R. So here we will see the interpreting betas. That means what does it mean. So here has a simple table to understand whenever beta 0, it is unaffected by the market movement. Whenever beta 0.5, so it is a movement move in same direction as the market. Whenever it is positive, so only half as responsive as the market. Whenever 1, same as response to the market. 2, twice responsive as the market. Whenever beta is negative, that means opposite directions. So whenever is 0.5, minus 0.5, only half as responsive as the market. Obviously that is the opposite responsive. If the market change by 1% positive, then the this stocks return should be changed by minus 0.5%, 5% if beta is 0.5. In the same way, if beta is minus 1, if the market change positive 1%, it is changed minus 1%, minus 1%. In the same way, if the market change minus 1%, then this stocks return should be changed plus 1%. So that is the opposite directions to twice as the responsive as the market. Portfolios betas. The beta of a portfolio can be easily estimated by using betas of individual stocks assets includes. So weight, so we have to consider the weight and the individual stocks beta. Then if we combine individual stocks beta, the portion of weights, then we can easily calculate the portfolio beta. Obviously it should be 1. So here is the examples that can we easily understand. For an example, when the market return increased by 10%, a portfolio with a beta 0.75 with the experience of 7.5% increases in the returns. So portfolio with a beta of 1.25 experience a 12.5% increases in the return in this way. So in the previously we have discussed in here, that's are explained in this examples very well by the Gitman, Professor Gitman. So here is an example to understand the portfolio beta. So here is the assets, asset 1, 2, 3, 4, 5, then portfolio V and portfolio W. Portion should be added. A asset, one asset has the beta 1.65, asset 2 has the beta 1, asset 3 has the beta 1.30, 4 has the 1.1, 5 has the beta 1.25. So these 5 assets create a portfolio named portfolio B, created the portfolio. So here is the portions. Asset A, 1 asset 0.10, in the same way asset 2 0.30, 3.20, 4.20, 5.20 is we know that all portion should be 1, weight should be 1. Then portfolio beta should be 0.10 into 0.165 plus 0.30 into 1, 0.20 into 1.30 plus. In this way we can calculate the portfolio beta. Here is the formula. So here is V portfolios 0.10 into 1.65 plus 0.30 into 1. So in this way we can from the calculations of portfolio beta is 1.195 or about to 1.20 beta. So in this way beta W portfolio W beta can be created in this way, whereas now 0.91. So you can see. Then we will see the equation of CAPM model of CAPM, capital asset pricing model. R is equal to RF plus beta J into RM minus RF. This is the capital asset pricing model. RJ required return on asset, J RF risk-free rate of return, commonly measured by the return on a USA treasury bill or government treasury bill. Beta J beta coefficient or index of non-diversifiable risk for the asset J. RM market return on the market portfolio of an assets. Actually these are the formula of our CAPM. CAPM can be divided into two parts. One, risk-free rate of return RF, which is required return on a risk-free asset, typically 3 months government treasury bill or a short-term IOU issued by the government treasury. Number 2, the risk premium. These are the respectively the two elements of either side of the plus sign equation. R J equal to RA plus beta into RM minus RF. So the portion RA minus RA portion of the risk premium is called the market risk premium because it represents the premium the investor must receive for taking average amount of risk associated with holding the market portfolio of asset. So here is the example. Benjamin Corporation, a growing computer software developer, wishes to determine the required return on an asset G, which has a beta of 1.5, risk-free rate of return is 7%, the return on the market portfolio is 11%. Then what would be the required rate of return for this asset? So it is understood that risk-free rate of is 7%. So 7% is enough for the investor. But whenever this investor takes more risks, then he expects more return from his investment. We know it very well. So here it is seen that market portfolio provides 11%. So what amount he takes more? That is 11 minus 7%. That is he takes 4% risk more by taking the G assets. So market risk premium of 4%. Market risk premium is 4%. That means this amount he takes more beyond the 7%. That's why he's adjusted the assets index risks. Here is the beta index is 1.5. If 1.5 is multiplied with this risk premium, the rate is 6%. So the result risk premium of 6%. So this is the market risk premium, or here the result is risk premium is 6%. That risk premium when add to the 7% risk free rate, the result is 13% required rate of return. So if a investor takes the asset G, one is investment, then the investor will require 13% rate of return. So one this being equal, the higher the beta, higher the required return, and lower the beta, lower the required return. It is seen that. After that we will see security market line. The graphical representation of capital asset pricing model is called the security market line. When the capital asset pricing model is depicted graphically, it is called the security market line or SML. Will the fact be a straight line? It reflects the required return on the marketplace for each level of non-diversifiable risks or beta. So the graph risks as measured by beta is plotted on the x-axis and required return are plotted on the y-axis. The risk return trade-off is clearly represents the SML. From these examples we will clearly see this SML. From these examples where we have the 7% risk-free rate, here is the 7%. So in the x-axis has the beta and y-axis has the required rate of return. So it is clear that. So 7% as our risk-free return. After that, whenever beta is 1, that is whenever beta is 1, that means it is the return of market return. So it is clear to us that market return is 11%, that means it has the beta of 1. So it is too much clear. So market risk premium is 4. So that is intersect in these positions. And our Z stock Z has a beta 1.5 and our required rate of return is 13%. That are intersect in these sections. Then if you draw in this way, that is our SML. That is asset Z's risk premium is 6% and market risk premium is 4%. So these are the SML, our required SML, security market line.
This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.